what is gold doing right now? It's been consolidating. It hit that 2,400. Go back a little bit. It went through the 2,000 level, number one, which a lot of people thought it was going to be a triple top. It will never, go through that level. It did. And now it's consolidating in that period. Technicians saying, now we're going to go back to, 2,000, below 1,800, blah, blah, blah. What we're doing here is consolidating and seeing what the 2-year yield is probably going to do, which is, this chart's actually old now because things are changing so fast. There is a decline in the 2-year yield already implied in this. And a reason why gold has been holding up so well. Where do we go here? All right, well, let's assume we go to 2%, probably very likely. Would it surprise you if we have a move up to 3,000 on gold? No, it shouldn't surprise anyone.
Tavi Costa, a financial analyst and portfolio manager at Crescat Capital, specializes in macroeconomic trends and precious metals. He emphasizes global investment strategies and advocates for gold and silver as effective hedges against economic uncertainty. Costa notes that gold's recent performance has drawn significant attention. After breaking through the critical $2,000 per ounce level, a barrier many viewed as a potential triple top, gold surged to around $2,400, surpassing expectations that $2,000 would be a strong ceiling. Gold prices held steady on Friday after a notable rise in the previous session, supported by a decline in US Treasury yields. Investors are increasingly confident that the Federal Reserve will lower interest rates in September. Spot gold remains at $2,427.73 per ounce, following a 1.9% increase on Thursday, while U.S. gold futures settled 0.4% higher at $2,473.40. Costa observes that gold has now entered a consolidation phase, leading to mixed opinions among market technicians. Some predict a potential retracement back to $2,000 or even below $1,800. The market remains holding, closely monitoring broader financial trends, especially the 2-year Treasury yield movements. Costa highlights that a decline in this yield might support gold prices. As reported by Reuters, Saxo Bank's Ole Hansen stated that after an unexpectedly strong performance in 2023, further price increases are anticipated in 2024. These gains are expected to be driven by a combination of momentum-chasing hedge funds, continued robust purchases of physical gold by central banks, and renewed demand from ETF investors. Before diving into Tavi Costa's video, subscribe to our channel, like this video, and share it with anyone who would benefit from it.
If you were to point out to a chart that shows what was a regime shift and what asset class would show that, one of them would be this one, because you would think, imagine you're trading this and you see 2-year yield actually hitting, this resistance line and falling every time. And every time we've seen this was actually a big recession. And this time now we went through it. And as we went through it, a lot of people thought, this is what is going on. I'm lost. And I thought this was going to hit resistance and go back down. This is what it causes when you get into an inflationary era, when the Federal Reserve and other central banks that never dealt with this issue are having to deal with the problem in a delayed manner. That's why we saw many central banks in developed world economies having to deal with the inflation problem much later than emerging markets. It would be now plausible again to see this go back to the resistance line, which would be forming a support in this chart. And that would be around the 2% area. That is a massive move. For those who don't know, I don't know if you're going to have the chart there, but if there is a chart that I posted that looks at the 2-year yield versus gold, and maybe you do have that. Okay, then we're going to talk about that. Look at that. This guy is just, man, he is on a roll. Ultimately, that's where we go, right? This is, okay, so we go to 2%, and where do we go with gold? Well, there it is. Gold tends to rally massively during those times. And what is gold doing right now? It's been consolidating. It hit that 2,400. Well, actually, let's go back a little bit. It went through the 2,000 level, number one, which a lot of people thought it was going to be a triple top. It will never, go through that level. It did. And now it's consolidating in that period. Technicians saying, now we're going to go back to, 2,000, below 1,800, blah, blah, blah. What we're doing here is consolidating and seeing what the 2-year yield is probably going to do, which is, this chart's actually old now because things are changing so fast that there is a decline in the 2-year yield already implied in this. And a reason why gold has been holding up so well. So where do we go here? All right, well, let's assume we go to 2%. which I think it's, probably very likely. Would it surprise you if we have a move up to 3,000 on gold? It shouldn't surprise anyone. That is a big change in a lot of things. I mean, look at the miners. I mean, what would that do to the mining industry if interest rates fall, gold goes to 3,000 or so? I mean, I think that can change drastically the fundamentals of this industry. So that's just one example. What does that do to silver? Silver is extremely undervalued. What does that do to other metals like copper and other things? It is interesting when you have a declines in the market and the metals are actually behaving with a lot of resilience, because as we see that moving forward, it feels like you're just holding metals like a beach volleyball under the water, and it's about to explode to the upside. When the market collapses, it only goes down a small amount, as we would expect, but it's not collapsing. It's actually holding up very well, which means once we go through that storm, we're probably going to see much higher levels for those assets. And so it's remarkable what's going on. I'm extremely bullish in the space, long-term bullish. And I think that you should approach this in that manner, because it's going to unleash a lot of opportunities.
Recent economic indicators have raised concerns about a potential U.S. recession, with unemployment trends taking center stage. Economic analyst Costa says unemployment rates are upward, a classic harbinger of financial distress. Notably, government jobs comprise an increasingly larger share of the labor market relative to private sector employment, a shift that has historically signaled impending recessions. These developments have reignited fears about the overall health of the U.S. economy. However, as attention turns to unemployment, a more pressing concern emerges: the stability of the unemployment insurance system itself. This system, designed to provide a financial safety net for laid-off workers, showed significant strain during the COVID-19 pandemic. There are now growing worries that it may not withstand another economic downturn. Let's get back to the interview.
I emphasize the yield curve quite a lot, and I think this indicator is also important because it looks at labor markets, and the labor markets have some uniqueness and some other things that are very part of the cycle. Things that are part of the cycle are the fact that we're seeing a trend higher in unemployment rates that is being caused by just a normal problem of corporations. If we looked into job openings, for instance, the number of government jobs relative to private companies actually hiring people, clearly we're seeing a shift there where government jobs are becoming a larger percentage of the labor market. And that's been the case for some time now. That trend has been higher. And every time we see that, it's a recession signal. So labor markets are showing cracks, and it's very important to pay attention to that. However, even from the number of immigrants that we had recently, the surge of call it illegal immigrants that we've had, that is also adding to the uniqueness of the labor market today. That it's important to point out, because most of those folks are actually unemployed now. And so that's increasing the unemployment rate in a significant way. So that's one segment that is slightly unique of today. But in my view, labor markets are cracking regardless, and it will probably continue to see this trend. And I think it will be impeccable at the end of this cycle. Another time that this indicator has proven to be right in terms of predicting a recession. But the last thing I wanted to point out in this chart is that we all have an obsession looking at labor markets and inflation to sort of see what happens with Fed policy. But at the end of the day, it doesn't really matter. All you got to look at is how much interest payment we're paying relative to GDP right now, not only with the US alone, but relative to the other places in the world and other developed economies. The US is about to spend close to 4 to 5% of GDP on interest payment relative to the economy. At the same time, if you look at places like Japan, Germany, Canada, they're all below 1%. So there is an inconsistency of the policy rate of the Fed versus this growth in the debt problem that we're seeing. And that adjustment is going to have an impact on the dollar. So I've been actually very bearish the dollar, believe it or not. And I think it's remarkable what we're seeing in terms of the sell-off in NASDAQ and S&P that is not also causing the dollar to appreciate, as we tend to see. Remember, people have margin calls, and what do? They buy the dollar. Why is the dollar not going up? It has to beg the question. I think there's some much more structural shift happening right in front of us of capital flows out of the dollar for those reasons I just mentioned, inconsistency of interest rate policies versus other places in the world. And that's going to have an impact that will likely weaken the dollar as well much further.
With gold approaching the $3,000 mark, the ramifications for silver are profound. Historically, silver tends to follow gold's movements, but with amplified volatility. A surge in gold prices is likely to trigger an even more pronounced rise in silver, especially given its current undervaluation. This potential for substantial gains in silver, coupled with the bullish sentiment in the gold market, underscores the importance of closely monitoring these developments. What do you think lies ahead for gold prices as the market keeps evolving? Share your thoughts in the comments below. We'd love to hear from you. If you found this video helpful, hit the like button, subscribe to our channel, and share it with your friends. We're committed to bringing you the latest insights to keep you ahead of the market. Thanks for watching.